And if you've glanced at the markets in the last, hour or so, you're probably seeing a lot of red.
A lot of red. And specifically around one company, Intel. The semiconductor giant just reported earnings, and in after-hours trading, the stock is, it's falling off a cliff.
Down over 10% as we're speaking.
Yeah.
It is an absolute bloodbath out there.
And normally when you see that kind of drop, a double-digit drop right after an earnings call, the story's pretty simple.
Right. The narrative is usually they failed, they missed revenue, nobody's buying their product, the business is shrinking. Simple.
But that's what makes this so interesting and frankly so confusing. That standard script, it just doesn't apply here.
Not at all. Because if you look at the last 3 months of 2025, Intel actually beat expectations.
And the demand for their AI chips is booming. By all the normal metrics, they should be popping champagne corks.
Instead, investors are hitting the sell button as fast as they can, and that creates this paradox.
A paradox. You have a company winning on the demand side. Everyone wants what they're selling, but the market is just punishing them.
So our mission today is to figure out why. We need to look past the headline numbers on the balance sheet and get into the physical reality of this AI boom.
Right. We tend to think of AI as just software, code that lives in the cloud somewhere.
Floating in the ether.
Exactly. But today is a huge reminder that the cloud is made of silicon. And what we're seeing with Intel is what happens when you have all the orders in the world, but your factories literally run into a physics problem.
It's the AI dream colliding with manufacturing reality. So we're going to break this down. First, the good news, that Q4 beat.
Then the shock, the guidance for Q1 that caused this whole mess.
And that'll take us right into the core of it, a little concept called yield. It's the root of all the pain right now.
And we have to talk about the huge plot twist, too. There's a $5 billion investment from Nvidia, of all companies, that complicates everything.
Plus, the arrival of 18A manufacturing right here in the U.S. It's the light at the end of the tunnel.
A very, very expensive tunnel.
You got that right.
Okay, so let's start with the financials from Q4 2025. Because before all the guidance dropped, things actually looked pretty good.
Surprisingly robust, yeah.
Yeah.
I'm looking at the revenue. It came in at $13.67 billion.
Which, to be fair, is down about 4% from the year before, so it's not like they're breaking records.
No, but it's all about expectations.
Mm-hmm.
Wall Street was bracing for $13.43 billion. So Intel cleared that bar pretty comfortably.
They cleared revenue, but they absolutely vaulted over their earnings expectations. Adjusted EPS came in at 15 cents.
When the prediction was only around 9 cents. That's an 82% beat. Usually, that's a massive buy signal.
So where did that beat come from?
It came from the star of the show,
Yeah.
the DCAI group, that's data center and AI.
Huh.
That unit pulled in $4.74 billion, which is up almost 9% year over year.
And this connects to that bigger idea we've been tracking, right? The shift from chatbots to AI agents.
Exactly. For the last few years, it's been about asking a model a question and getting an answer, a quick burst of compute.
But agents are different.
They're totally different. They're autonomous systems running in the background all the time, booking flights, managing supply chains, writing code 24/7.
And that requires a completely different kind of hardware setup.
Drastically different. It's a persistent workload, not a burst.
Yeah.
And that means companies are upgrading their server CPUs to handle it. And Intel's numbers basically confirm that upgrade cycle is real. It's happening now.
Which is a good thing, because the consumer PC side, the laptop you're probably listening on, is still looking pretty shaky.
Shaky is a polite word. The client computing group was down about 6.6%. The big PC refresh cycle hasn't quite kicked in.
So the AI data center demand basically carried the entire company.
It carried the water for everyone, yep.
Yep. Okay, so picture this. It's 4 p.m., the report drops. Revenue beat, earnings smashed, AI is growing. If I'm an Intel investor, I'm feeling pretty good right now.
You're thinking the turnaround is finally here. You're making dinner reservations. And then the conference call starts. And the guidance for the next quarter drops.
And that's when the mood went from, cautiously optimistic to just sheer panic.
Complete panic.
So let's look at this Q1 2026 forecast. Revenue is projected between 11.7 and 12.7 billion. The street wanted 12.6 billion.
So the best case scenario is basically just meeting expectations.
Not great, but that wasn't the worst part.
Oh no, the revenue miss is, manageable. It's the profit forecast that made the trading algorithms just dump the stock.
I honestly had to double check this number. It looked like a typo.
It's just stark.
They expect adjusted earnings per share to be
Yeah.
zero.
Zero. A goose egg, nothing.
But the consensus was 8 cents a share.
which was already pretty low. But Intel is saying, look, despite all this revenue, we expect to generate absolutely no profit for our shareholders this quarter.
How does that even happen? We just established that demand is high. The CEO, Chen Liwu, said it himself, demand is quite strong.
Right.
Usually when a company makes no money, it's because no one is buying their stuff. But people are buying the chips, so where is all the money going?
And this brings us to the key idea for today. It's a little term called gross margin.
Okay.
Intel's gross margin, which is the money they keep after the cost of actually making the product, is expected to fall to 34.5%.
34%. For context, what was it historically?
In their glory days, they were in the 60% range.
Yeah.
Dropping into the mid-30s is a full-blown crisis. It means for every dollar they bring in, they're spending 65.5 cents just to make the chip.
And that's because of a yield problem.
It's 100% a yield problem.
Yeah. Okay, let's define that. Yield gets thrown around a lot. For someone who doesn't work in a semiconductor fab, what does that actually mean?
So imagine you're not making one chip at a time. You're starting with a big, round silicon wafer. Think of it like a 12-inch pizza made of pure crystal.
Okay.
And you use this incredibly complex process to etch hundreds of individual processors onto that one wafer.
All at once.
All at once. Now, in a perfect world, a fantasy world, every single one of those hundreds of chips works perfectly. That would be 100% yield.
But we don't live in a perfect world.
We live in a world with physics. And at this tiny scale, nanometers, physics is incredibly messy. A single speck of dust, a tiny temperature change, it can ruin a chip.
So you test all the chips on the wafer and some of them just don't work.
Exactly. Maybe only 60% of them work. You got to throw the other 40% away. Your yield is 60%.
But you still paid to process the whole wafer. The electricity, the chemicals, the $20 billion factory.
And that's the crucial economic point. The cost per wafer is fixed. If you get 100 good chips from it, your cost per chip is low. If you only get 50 good chips because of bad yield, your cost per chip just doubled. You are literally throwing money away.
And Intel is basically admitting their yields are bad right now.
The CEO was surprisingly blunt about it. His quote was, "Our yields in manufacturing did not meet my standards." That is CEO speak for, we are scrapping way too many expensive wafers.
The CFO, David Zinsner, he said Q1 supply will hit a low point.
Which explains the paradox. To get those good sales numbers in Q4, they must have just burned through their existing inventory.
They raided the pantry.
They raided the pantry of all the good chips they had on the shelf because the factory wasn't making new ones fast enough. And now, in Q1, the pantry's bare.
They can't ship what they can't make. It's a classic bottleneck.
It is. Morgan Stanley called it a double-edged sword. It's great to have the demand. That's the opportunity. But if your factory floor can't execute, the demand just highlights your weakness.
It's an execution challenge. They're trying to run a marathon, but they keep tripping.
It is, but, and this is important, while the yield problem is why the stock is crashing today, there's a much longer-term story in this report that's actually a really big deal for American tech.
You're talking about 18A.
I'm talking about 18A.
That sounds like a flight number. Why is this so important?
The A stands for angstrom. It's a unit of measurement. We're talking about things that are just a few atoms wide. 18A is Intel's newest, most advanced manufacturing process.
And the big news is?
The big news, the silver lining here, is that 18A is now officially in high-volume manufacturing. This isn't a lab experiment anymore.
And this is happening in the U.S., right? In Arizona and Oregon.
That's the key strategic point. For the last decade, the king of advanced chip making has been TSMC in Taiwan, full stop. 18A is Intel's attempt to take that crown back and to do it on American soil.
This is that Made in America manufacturing push we've been hearing about for years.
This is it. It's happening. They have a real product, the Panther Lake processors, coming off those lines. It proves the technology works. It's not just a PowerPoint slide.
So if the technology is so great, how does this connect back to the financial pain? Is A18A part of the reason their margins are so bad?
Oh, absolutely. It's the cost of innovation.
Explain that.
When you fire up a brand new manufacturing line with brand new bleeding edge technology, it is incredibly inefficient at first. You have to dial in thousands of variables.
So the yields on a new process are always terrible at the beginning.
Always.
Yeah.
It's called the ramp-up phase. You're spending billions to run the machines, but you're getting very low yields.
So they're taking this huge financial hit today.
To get this factory working for tomorrow, they're telling investors, swallow this bitter pill now, because 18A is the technology that will make us competitive for the next 5 years.
It's a huge gamble. Long-term competitiveness versus short-term profit.
A very expensive gamble.
Speaking of strange gambles, the Nvidia news. I almost fell off my chair when I read that part of the report.
The $5 billion twist.
Yeah. We always frame this as Intel versus Nvidia, the bitter rivals. And yet, this report confirms Intel sold $5 billion of its own stock to Nvidia in Q4.
It sounds crazy, right?
Huh.
Why would the king of AI give the challenger a $5 billion war chest?
That's my question. Why would you fund your competition?
You have to look at the whole ecosystem. It's not just a rivalry. It's a frenemy situation.
Okay.
First, Nvidia needs CPUs. They're huge, expensive AI systems. They don't run in a vacuum. They need a host processor from Intel or AMD to manage everything. They need a healthy CPU supplier.
So it's about protecting their own supply chain.
That's part of it. But the bigger angle is manufacturing. Nvidia doesn't make its own chips, right?
No, they design them, and TSMC in Taiwan builds them.
And that single point of failure in Taiwan is what keeps Nvidia's CEO up at night. They are terrified of being 100% dependent on one supplier in one geopolitical hotspot.
They need a backup plan.
They are desperate for a backup plan. So by investing $5 billion in Intel, they're essentially placing a bet, a down payment on the idea that Intel's foundry business, their factory for hire service, will eventually succeed.
So if Intel can get 18A working properly in Arizona?
Nvidia might become one of their biggest customers.
Yeah.
That $5 billion is a vote of confidence. It's an insurance policy.
Which is why Intel stock was actually up 47% heading into this year. The market saw that investment as a huge seal of approval.
It was. But that approval only matters if Intel can actually fix these yield issues.
So let's talk about that foundry business. Making chips for others, how is it actually doing?
It's a mixed bag. Revenue was up a little to $4.5 billion, but the division is bleeding money. It's operating at a big loss.
Yeah.
And this public yield problem, that's a massive reputation killer for a foundry.
Of course. If I'm a potential customer, like Apple or someone, I'm watching this. And if I hear Intel say, we can't even make enough of our own chips efficiently, I'm not exactly going to trust them with my flagship product.
It creates a huge trust gap. And Chen Liwu was very honest about it. He said rebuilding the foundry will take years. Years.
Wow.
He even said customers for the next generation of tech, 14A, won't even really show up until the second half of this year.
Years is an eternity in the tech world.
It's a lifetime. And that's the danger zone Intel is in. They're asking for patience from a market that has absolutely none.
Okay, let's zoom out. So we have a company, Intel, that is clearly at the center of the AI boom. The demand is real.
The AI opportunity is real and it's unlimited.
But they are stuck in the mud of manufacturing reality. They can't get out of their own way on the factory floor.
And management is basically saying, trust us. They're promising that this quarter, Q1, is the bottom, that things will get better in Q2. They're asking for faith that they can fix the ovens and stop burning the pizza.
It really just highlights this disconnect we all have. We live in a world of instant software updates. You think if something's broken, you just push a patch and fix it.
Right, a teenager can write code in their basement and change the world in a week.
But building the physical brain to run that code.
That's about moving atoms.
Yes.
It takes billions of dollars, giant factories, hazardous chemicals, and perfect execution. You can't just patch a defect on a piece of silicon.
And when that execution slips by even a tiny fraction, you get a 0 profit quarter and a 10% stock crash.
That is the unforgiving math of hardware. It's binary, it works, or it's useless sand.
So here's a thought to leave you with. We spend all this time debating AI. Will it take our jobs? Will it get too smart? We assume the only limit is the algorithm.
But today's news suggests there might be another limit, a physical one.
Exactly. When you see a company like Intel, one of the most advanced manufacturers in history, struggling with something as fundamental as yield, you have to wonder, could the physical limitations of manufacturing be the real speed limit on AI? If we simply can't build the chips fast enough or cheap enough, does that whole exponential curve of AI start to flatten out?
That is the multi-trillion-dollar question. At the end of the day, physics always wins.
Something to think about. You can check our show notes for links to the earnings reports and more on that 18A node we discussed. Thanks for listening.
Until next time.